Good morning, everybody, and welcome to this month's webinar, sustainability webinar, where we're looking at assessing climate-related risks and opportunities. Exciting webinar, exciting topic that we're talking about. Now, normally Kevin Frobus would join me. Unfortunately, he couldn't make it today, but he'll be back next month. So I'm on my own. Talking about climate-related risks and opportunities, but thank you very much for joining me today. I would like to begin by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present, and we extend that respect to Aboriginal and Torres Strait Islander peoples here today. Just a reminder that this is the 7th sustainability webinar for 2024, and we've got a few really good webinars lined up for the rest of the year. So next month we look at climate-related scenario analysis, then we look at processes and policies to manage your climate-related risks, understanding the relevant climate-related metrics, setting targets in November, and climate-related disclosures in Australia in December. So please register for those webinars and join us over the journey. If you miss the live webinar, you can always watch a recording. We also have monthly IFRS and corporate reporting webinars. Quite often there's a bit of an overlap between we discuss in sustainability and we discuss within the IFRS and corporate reporting webinars. So what will we be looking at today? Now, in today's session, I would like to start by flagging a collaboration between BDO and Chartered Accountants, Australia, New Zealand, where we've co-branded our sustainability roadmaps. And I'll flag that and I'll give you a link to access it on our website. It's also available on Chartered Accountants, Australia, New Zealand's website. And then we'll get into the session where we look at why are we looking at climate-related risks and opportunities? What are climate-related risks? What are climate-related opportunities? We look at climate risk assessment with an industry focus. So how is it different per industry? And we end up with a climate risk assessment methodology. And then finally, how BDO can help. However, before we jump into the session, just yesterday, the AASB, which has the mandate to issue climate-related disclosure or standards around climate-related disclosures in Australia, issued an update on where they've gotten to with their previous consultation, which was an exposure draft issued in October 2023. Now, on many previous occasions, I've articulated my absolute dislike for that exposure draft. And you'll remember the key reason was that there would have been a quite different version of IFRS S1 and S2 in Australia as compared to the global IFRS S1 and S2. And I think Australian entities for sustainability disclosure standards want to be in the same position that we currently are on IFRS accounting standards, and that is, if you comply with the Australian standard, you should automatically also be in compliance with the global standard. So it should be easy for Australian entities. The AASB have taken a feedback, so there were more than 1,000 people at the events, the roundtables they held. They've received 289 survey responses. They've received 117 comment letters, including the BDO comment letter. And they've given you a bit of an overview there on who they've heard from. You can see they've heard from a lot of industry bodies, more than 30, professional services firms, more than 20, which would include BDO. And really, the feedback, the overwhelming feedback that they've received is that stakeholders of the AASB strongly encourage greater alignment with the international sustainability standards boards IFRS S1, S2 baseline. You know, and we've been really strong in saying that we don't want to make the mistake we made with IFRS accounting standards when we first adopted those in Australia in 2005. And there were too many differences. So I think they've taken on board that message, and they should be complimented on the fact that they've done extensive research, extensive outreach, and did take on board that feedback. Then on the right-hand side, so these are kind of two snapshots from the AASB consultation update published yesterday. They were talking about entities can voluntarily apply S1 and make sustainability disclosures beyond IFRS S2. So that's good. In-scope entity must apply IFRS S2, meaning that if Treasury is mandating certain entities, Group 1, Group 2, Group 3, to prepare sustainability reports, including climate statements, and they have to comply with IFRS S2. There's a back to baseline approach, which we really wanted, around scope, cross-industry metrics, greenhouse gas emissions, finance emissions, carbon credits, etc. And then, you know, so I think it's really important. It's a great initiative. You'll see on the right-hand side, right at the bottom, they said the board will meet again in August to discuss final drafting related issues. And shortly after that, subject to the passage of the legislation, which we know is up to be debated by Parliament on the 12th of August, they will issue the new standards IFRS S1, S2. So this is a great development, and fantastic to see that the AASB has considered the feedback by, I mean, many people. So fantastic. I wanted to share with you that, you know, previously I have shared with you our BDO sustainability roadmaps with the 3 project streams. We have recently, I think just over about 10 days ago, released together with chartered accountants our sustainability roadmaps. Now, if you want to look at the newly formatted, co-branded sustainability roadmaps, you can download it from our website. There's a link at the top, and it will take you to this download button. This is what it looks like. It's also on the Chartered Accountants website. You know, navigating Australian climate-related disclosure landscape. And you'll see on the right-hand side, our BDO team have done some quite amazing work coming up with a nicely formatted roadmap. It's the content are exactly the same content that we've previously had in the roadmaps that I've shared on the webinars. Slightly different formatting and pictures, but the same content. So there's one for Group 1 entities. The green blocks is when mandatory climate reporting is expected to be in place. So you'll see the 3 streams, a carbon footprint measurement, other climate-related disclosures, and at the bottom, a strategic focus. And then for Group 2, there's an additional year to get ready. And for Group 3, yet another additional year to get ready. But we don't want to wait. How do we slowly get ready? So those roadmaps have been launched, and just wanted to flag that. Coming back to today's session, looking at climate-related risks and opportunities, you know, why are we looking at climate-related risks and opportunities? I think it's important to have a look at the Intergovernmental Panel of Climate Change, the IPCC's most recent document on climate change. So there's a Climate Change 2023 report. And, you know, I've put in a link there to that report, and again, an image so you can see what it would look like. The IPCC is the United Nations body for assessing the science related to climate change. So if you want to look at climate change, the latest science, I think that's a really good place to start. What's interesting, if you go on the website and you look at that report, there are regional fact sheets, which I think is fascinating reading. And it really sets the scene really nicely for considering climate-related risks and opportunities for you, for your particular business. So it's going back, and first of all, I'm going to share here and talk through the regional fact sheet for Australasia, but there are regional fact sheets for other areas. So if you've got subsidiaries in Europe or in other regional areas, you can look at those fact sheets as well, which could be a starting place for your risk assessment for those different regions or legal entities. This is just an example of what a fact sheet looks like and what kind of information would be in there. Um, so if you look at this regional fact sheet for Australasia, there are certain common regional changes that they want to flag. So one of the things they say, Australian land areas have warmed by around 1.4 degrees Celsius between 1910 and 2020. And they've got very high confidence in that assessment, so they give that assessment as well. And annual temperature changes have emerged above natural variability in all land regions. And then in the second item, they talk about heat extremes have increased, cold extremes have decreased, and these trends are projected to continue. They also talk about in the third one about relative sea level rose at a higher rate than the global average in recent decades. Sandy shorelines, which we love in Australia, have retreated in many locations, and relative sea level rise is projected to continue in the 21st century and beyond. And that would contribute to increased coastal flooding and shoreline retreat along sandy coast throughout Australasia. For those of you who like skiing, like my children, the fourth bullet point, snow cover and depth have decreased and are projected to decrease further. And we read that in the paper as well, and the ski resorts and what's happening there. They also say in the fifth bullet point, frequency of extreme fire weather days has increased, and the fire season has become longer since 1950 at many locations, and the intensity, frequency, duration of fire weather events are projected to increase throughout Australia. Heavy rainfall and river floods are projected to increase in marine heat waves and ocean acidity is observed and projected. And then enhanced warming in the East Australian current region of the Tasman Sea is observed and projected. Sandstorms and dust storms are projected to increase throughout Australia. And then there's also changes in several climatic impact drivers, so heat waves, droughts, floods, and it would be more widespread at 2 degrees Celsius compared to 1.5 degree global warming, and even more widespread or pronounced for higher warming levels. So this is just focusing on Australasia and gives you a focus on this region. They also go on and then they give you some information around annual maximum temperatures. And then they talk about, the expected annual maximum temperatures if there's a 1.5 degree Celsius global warming, a 2 degrees Celsius global warming, and a 4 degrees Celsius global warming. So again, interesting information, but absolutely focused on Australia, a good starting point. They also go on and they talk about the different regions within Australia. So, if you've got offices, manufacturing facilities, etc., in various different regions in Australia, you can go and have a look at what that would mean for your business, your office, your factory in that region. So if you have a look at Eastern Australia, right at the bottom, for example, projected decrease in mean cool season, rainfall, but more extreme rainfall events. Um, Agricultural and ecological droughts are projected to increase at 2%, or 2 degrees Celsius global warming and greater. So a number of very valuable observations, and it's not just observations. This is research um, that's been conducted by the United Nations, so could inform your climate risk assessment. So I just wanted to flag that so everybody is aware of that. Oops, I don't know what's happened here. Anyway, right. So with that as an introduction, so the latest scientific report around climate change, climate risk, as issued in 2023, let's move on to what are climate-related risks. So climate risks have been categorized into two things. So first of all, physical risks. So that would be climatic events and chronic issues such as water security, natural disasters, increased exposure to location hazards. So if you look at physical risks, it's changing climate conditions, it's extreme weather events that could have a direct damage to assets or property. It could lead to lower asset values, it could lead to increased insurance claims, and it could lead to supply chain disruptions. So that's the physical risk side of climate risk. A lot of people focus on climate risk, as a focus on physical risk when they think of climate risk, but a really big part of climate risk is actually transition risk. And that is how organizations transition to a low carbon economy. And that would include policy and legal risk, technology risk, regulatory risk, marketing and reputation risks. So if you look at transition risk, what are the potential policy changes that we could see that would assist with a low carbon, to transition to a low carbon economy? What could the technological innovation be that would pose a transition risk for certain entities, or the social adaptation risk around transitioning to a low carbon economy? Now, all of these transition risks could have an impact on pricing of your products and your services, as well as demand for your products and services, supply and demand. You could be left with stranded assets, and there could be organizations defaulting on loans due to these risks. So I think my key point, and the first point here, is that climate risk is not just physical risk, but transition risk is actually significant and should be considered in great detail. So if we look at an overview of climate-related risks, as I said earlier, physical risks is part of it, but look at transition risk, look at how wide it is. So for your business, it's a question of sitting back and saying, if I consider climate change, and if I consider the latest scientific evidence, and I then think, what are the climate risks that's applicable to my business? You would think of all of these categories, and you'll want to assess what are the physical risks that could potentially impact my business. So when we look at physical risk, we look at acute physical risks and chronic physical risks. So acute risks, that would be event-driven risks due to increased severity and frequency of extreme weather events. That is acute physical risks. So what does the research say about the potential for acute physical risks, and how does it impact all the different places where you've got offices and factories, etc.? But then we also have chronic physical risks. So again, what are the risks associated with longer term in climate patterns? So rising sea levels, etc. So physical risk, I think most people fairly easy to get their head around what is a physical climate risk. If you look at transition risks, This is where you really have to understand your business, your industry, your business model, your strategy. And here we have to think about how could potential policy and legal changes pose a risk to our business. So it could be policy changes that could restrict and or promote actions and legal risks. Policy risk could be new policies that would promote certain activities, or it could be policy changes that would try and restrict or limit certain actions. So maybe there would be policy changes in order to make sure we get to a lower carbon economy, and maybe there's carbon pricing mechanisms that would be introduced. And from a policy perspective, an example in Australia would be the safeguard mechanism for the largest emitters. That's policy actions to make sure that the largest emitters in Australia are committed to reducing their emissions through the ENGA scheme and also the safeguard mechanism. That's a policy matter. A policy matter would be the introduction of mandatory reporting, and mandatory reporting would include the disclosure of climate-related risk, disclosure of carbon footprint, disclosure of targets. Again, that's a policy matter. How does it impact your business? But then there's also legal. So legal risk refer to potential litigation risks. Now, we know over a number of years we've seen some stakeholders are taking litigation action against companies for not protecting the business against climate-related risks. So that litigation risk is in there as well. The second transition risk to consider, and again, you need to know your business, is what are the potential technological improvements or innovations that could potentially be developed in response to climate change? And what would the impact of those technological improvements or innovations be on your business? So, for example, new technology around renewable energy, new technology around battery storage, a lot of potential new technology and innovation that could pose a risk to your business model, maybe because you've got more traditional technology in place. And therefore, this could be a real competitor for you in the market and could impact your potential products or services if you're not embracing it. It could also be an opportunity for you if you are embracing these technological improvements and innovations. Another one is if there's new technology out there that is manufacturing certain products with lower carbon emissions, and that's quite different to your items or products that you're selling, that could have an impact on supply and demand. It could have an impact on pricing. It could have an impact on expected useful life of your assets. So that's technology and innovation. If you look at the market, market risk, and this is where we're looking at customers and customer behavior. Market risk is varied and complex. So here we're looking at the potential market risk, is the impact of electrification of transport on the freight industry. So if there's a push that all transportation should move as far as possible to electrification or use of electric vehicles, and your business is not embracing that, that's a big market transition risk for your business. And then if you think about reputation, reputation is the perception of customers and the broader community around your business and your business willingness, ability to embrace climate change and limit damage to the environment. So reputationally, what are we doing? So certain industries will find that harder. So these are the kind of risks to think of holistically. But you can see here, you have to understand your business, your model, your business model, your strategy. You also have to understand your industry. You have to understand what peers and competitors are doing. And often when we do a transition risk assessment, we would also look at not just what our competitors in Australia doing, but because Europe is so far ahead, what are similar industries already doing in Europe, to get an idea of where this is potentially going. So these are all the broad risks that businesses should consider as part of a climate risk assessment. Now, a really important thing is if we just come up with risks or come up with opportunities and we don't link it back to potential financial impact, it's really hard to get buy-in from your board, your audit and risk committee, executive leadership. If we say there are all these risks, but we cannot prove or quantify or link it to numbers in financial statements, and we can't articulate that financial impact, I think it's hard to make a real case and get action. Therefore, this figure is from the TCFD report. And it's saying if you look at all these transition risks, physical risks, and we'll look at opportunities later, and you look at all these opportunities, all of that should impact your strategic planning and your business model. It should impact your risk management, and your risk management framework should be incorporated into your risk register, and ultimately articulate how that would have a financial impact. So what does it mean for your revenues, your expenditure, your assets, your liabilities, your financing, etc.? So I think that is a really good diagram to integrate how all of this fit together. So my advice would be, if you are considering what are the climate-related risks for your business, don't stop there. Also say, what would these climate-related risks mean for our strategy? What would it mean for our risk management? And ultimately, how could it have a financial impact on your business? And I'll show you right at the end how we do that. So in this TCFD report, so a lot of what we talk about today is from the TCFD report, and it's from the TCFD guidelines. They talk about the main categories of financial impact, and there's no surprise here. These are the key categories that we see in any set of financial statements. So first of all, if you look at your income statement or your profit and loss, one item that would potentially be impacted is revenue. So they're actually trying to say, when you're considering financial impact of climate risks, these are the key categories you should consider. So revenues, apologies. How would your transition and physical risks affect demand for products and services? Because if there's lower demand for your products and services, it means there will be lower revenues. And I don't have water close by. I apologize for that. So not only will there be lower demand, so less volume, but that would also put pressure on your sales price. So organizations should consider the impact on revenues, but you should also consider if there's potential opportunities that you could innovate and therefore enhance or increase your revenues. So if you look at the emergence and the likely growth of carbon pricing as a mechanism to regulate emissions, it's important for those businesses to consider the potential impacts of such pricing on business revenues. So really important, if we're moving to a lower carbon economy, and we've already seen it with our clients, if your customers are expecting to buy from businesses that are already measuring their carbon footprint, setting targets, tracking progress against those targets, that is a risk for your business, because your customers will be talking with their feet and they'll go to another organization if they've got a lower carbon footprint for a similar product. So it's to be aware of customer behavior and how customer behavior could impact your revenues. And it comes back to that stakeholder engagement. What are our stakeholders thinking? What are our customers thinking? What are our customers' expectations? And I've previously told the story of one of my clients where a key customer said, we've changed our supply selection criteria. We've added sustainability and basically carbon footprint. It's weighted 20%, and it is what it is. We're just coming to inform you, and you need to respond to that. So it could impact your revenues through customers and customers' buying patterns. But there's also the other part on the income statement is not just the revenue, it's also potentially having an impact on expenditures. Um, so here we have to think about your organization's cost structure. So lower cost suppliers may be more resilient to changes in cost resulting from these climate related issues. And maybe they have more flexibility in their ability to address those. So it's important to have a look at your cost structures, your resilience or the flexibility of your cost structures to adapt, so you can provide that information to your investors. It's also important for your investors and your stakeholders to understand your future capital expenditure plans. So what additional capital do we need to invest in lower carbon technology? And therefore, if we have that capital expenditure plans in place, what is the level of debt or equity that we need to fund those plans in order to be resilient and to respond to these changes in climate change and expectations around low carbon emissions? So again, really important to consider your flexibility. So you might have capital expansion plans that was based on old technology. Now you have to rethink that. So I'll give you an example. If you have capital expansion plans where you were replacing your fleet of vehicles, let's say every 3 years, or your fleet of trucks every 3 years, and you've budgeted and planned to replace it with diesel vehicles, or fossil fuel vehicles. And now you realize, transportation, there's such a big focus on transportation, and the fuel that's burned in the transportation process, that you will have to replace potentially all your vehicles, your delivery vehicles, your trucks with electric vehicles. That would come potentially at an extra cost. There's also other practical issues around charging stations, etc. So have you considered that? And what would that do to your level of debt and equity funding? So if you look at your balance sheet, so we finished the P&L, but broad categories in the balance sheet, let's look at assets and liabilities. So if we are looking at assets that have a long useful life, maybe we've invested in assets, and these potentially infrastructure assets have an expected useful life of 20 years. But now we realize, due to these changes in technology and changes in customer demand, and we have to maybe get different assets to replace these assets, and we have to replace it sooner. We won't be able to use them for 20 years. So you have to potentially update expected useful life of these assets, which will increase depreciation expense. You might have to impair the value of some of these assets. So you have to reconsider maybe the previously committed activities around new investments, restructurings, impairment, a write down. So have a very good look at the value of your assets, but also on the liabilities. Have a look at if you've committed to reduce your carbon emissions to by a certain percentage, and you cannot do it, you can't achieve it through changing your activities, and you'll actually have to buy carbon credits. Or if you are subject to the safeguard mechanism and you have to buy carbon credits, when do we have to book those liabilities? And there's some accounting guidance around that, so you might have to book some liabilities. Also part of the balance sheet is the capital and the financing aspects. So due to the need to invest in different assets, maybe the need to do research and development activities, maybe new capital expenditures. You might have to raise new debt. You might have to refinance existing debt. And you might have to get additional capital from shareholders. So again, consider what you need to do that. And then it's interesting, if you need to look for new debt or refinance existing debt, we know that the banks are looking to finance entities that are on this lower carbon journey. And banks have to report their financed emissions. So in order for you to get access to financing, it would depend on what are you going to do with the money. Are you using it to invest in this new technology innovation to get to a lower carbon economy, or what are you doing with the money? And also, if you potentially want cheaper debt, you need to meet certain criteria as set by the financial institutions. From the TCFD report, they've particularly included a number of examples of physical risks and potential financial impacts. Now, I've repeated those here from the TCFD report, and I've tried to articulate, let's look at financial risks, examples of acute financial risk and chronic financial risks. And then on the right-hand side, and as extracted from the TCFD report, what are the potential financial impacts? So what they've done in the TCF report, they've actually drilled down into the details. So if you're exposed to these physical risk within the broader climate-related risk, what are some of the potential financial impacts to consider? So when you do this assessment, you would say, would we have reduced revenue because we've got decreased production capacity? That could be because there's transportation difficulties, there are supply chain disruptions. Maybe we're in a flood zone, and if there's a flood and we can't do any production during a number of months at a time, and that's going to increase the number of times we won't be able to work, there's reduced revenue because there's decreased production. Maybe there's reduced revenue and higher cost because there's negative impacts from a workforce. Maybe it's health or safety related, or absenteeism, maybe really hot weather, cannot come to work, or other health aspects that will impact your workforce due to climate change, changes in weather conditions. Maybe it is write-offs and early retirement of existing assets. Maybe it's increased operating costs because you don't have enough water. Maybe it's increased capital costs because there's damage to facilities that you have to replace. It could be reduced revenues from lower sales or output. It could be increased insurance premiums and a potential for reduced availability of insurance on assets that are in high-risk locations. So some people can't get insurance in certain areas. So physical risks, acute or chronic, these are the potential financial impacts. The TCFD report also looks at all the transition risks. So these are transition risks, so policy and legal risks. Maybe there's increased pricing of your greenhouse gas emissions. There's enhanced emissions reporting obligations, which we're expecting in Australia. Maybe there's mandates on and regulation of products and services. Maybe there's exposure to litigation. Again, what could that potentially mean for the numbers? So it's not just a risk sitting there, it's got a financial impact. It could increase your operating cost. You will have to potentially write off or impair assets, or maybe early retirement of assets. There could be increased cost and or reduced demands for your products and services. So again, you can see a very clear link, a potential financial impact. If you look at technology, it could be that we had unsuccessful investment in new technologies. Maybe there's additional costs that we have to incur to transition to these lower emissions technology. Maybe we have to substitute existing products and services with lower emissions options. So again, what would that mean for your assets, your liabilities, your income, your expenses, your financing, etc. So write-offs and early retirement of assets. Maybe there's reduced demands for products and services. Maybe we don't know what the solution is. Yes, so we have to have R&D expenditure. We have to do capital investments in technology, and cost to adopt or deploy new practices and processes. As I said earlier, if you look at the market and market-related transition risks, there could be changing customer behavior on what they're willing to buy, who they're willing to buy from, based on your commitment to sustainability. There could be uncertainty in market signals, and there could be increased cost of raw materials. So if you go to your suppliers, in order for them to provide goods to you with a lower carbon embedded in it, they have to increase their cost. So you have to pay more for the goods you buy. And again, you can see on the right-hand side potential financial impacts. So there could be, abrupt and unexpected shifts in energy costs. And energy cost is a big talking point in Australia. There could be increased production costs. Waste treatment is really critical as part of the greenhouse gas protocol and the emissions associated with that. There could be a change in your revenue mix. It could be a decrease in revenue, etc. And then if you look at reputation, again, there could be shifts in customer preferences, which we've already talked about as part of market. But there could be stigmatization of the sector. And there could be an increased stakeholder concern, or there could be negative stakeholder feedback across the activities of the business. And again, once the broader community, investors, etc., have this, let's say, negative view and a negative reputation, how does that impact your revenue? And how does it impact the availability of capital and the willingness to invest in this business? And we know that a large super funds, large investors are looking at investing in sustainable businesses. So again, we're already seeing those transition risks. How does it impact your business? So we've got all these things happening. The question is, to what extent is it a reality for your business? To what extent is it a risk for your business in the short term, medium term, long term? Because if you are saying that this is of no relevance to us, you are saying none of our investors now or in future will care about it. None of our customers now or in future will care about it. None of our people will be impacted by climate change. All right, so it's a big call. So how do we assess climate risk for our business? The other thing is the TCFD report has a separate implementation guidance report. And in that implementing guidance report, and I've got the link there for you, again, they talk about additional examples. So they talk about, if you look at revenue, look at the income from your normal business activities. And that would usually be from the sale of goods and services. So what are the kind of climate-related impacts that you should consider? Maybe there's changing market demand for your products and services. And maybe there's a shift in customer preferences. And maybe you should consider sensitivity of existing revenue streams, your products, your services. Consider, should you develop new revenue streams in response to these opportunities? So again, it's just a slightly different way of looking at it. And then they're talking about examples of potential impacts, revenue for operational disruption, revenue from changes in sales and products and services. Again, I don't know, some really funny things going on with my slides. They also look at expenditures, and these are operating expenditures. So they say, let's look at the ongoing cost of running a company. So what are the required or discretionary increases in operating expenditures that you have to incur to address climate-related risks? Are there maybe decreases in expenses as a result of increased energy or water efficiency? That could also happen. And then, examples, they say, what about R&D, research, development, and new technology? What about maybe changes in your purchased energy and water and other costs of supply and materials? Maybe there's increased production costs because you now have to do waste treatment and you need emission controls. Maybe there's additional costs to improve energy or water conservation. Maybe you've got additional expenses to address physical risks, so maybe insurance premiums recovery. So again, more examples of things to think about. When they look at assets, so we've previously talked at operating expenditure. Here they focus on capital expenditure. So if you look at, an expense where the benefit continues over a long period, so it's not recurring in revenue every year or recurring nature every year. So again, they say, what are some of the examples of potential impacts? Maybe there's additional capital expenditure required for new equipment, new technologies, adaptation, conservation, efficiency efforts. Maybe we need additional capital expenditure for physical risk mitigation. So the location of our facilities, maybe we have to move, improving our resiliency capabilities. Maybe there are investment hurdles affected by internal and external carbon prices. They also go on and they talk about, let's look at tangible assets maybe separately. What are the changes in the value of your tangible assets? So maybe there's changes in the value of assets based on emissions, energy, water intensity. Maybe there's write-offs or early retirements of assets. Maybe there's physical damage or impairment of assets due to weather events. They also look at intangible assets. So now we look at brands, copyrights, goodwill. So you also have to consider intangible assets. Is there maybe an increase and a decrease in your brand value? An increase and a decrease in the value of copyrights? Maybe a reduction or disruption in production capacity? Maybe there's impacts on your workforce management, employee attraction and retention. And when you look at liabilities, they look at contingent liabilities. Maybe we need contingent liabilities around legal liabilities for climate risks, or what about compliance penalties? And then if you look at that as contingent liabilities, but they also look at liabilities separately, looking at, what is the potential change in the amount of debt required, the amount of equity capital required, the credit rating applicable, the stock price, potential changes in your debt interest rates. So really very extensive examples of how climate-related risks are relevant to a business. So if you conduct a climate risk assessment, important to understand the business, think of all these potential risks, not just in the short term, in the medium term, the long term, and how it could impact your business. The International Sustainability Standards Board, or the IFRS Foundation, have also published some educational material in December last year, where they talk about the nature and the social aspects of climate-related risks and opportunities. And again, I've put in a link to this publication. And I've just extracted some parts of some of the examples to give you an idea. So one of the examples that they've put in their educational material is, they said, if an entity operates in agricultural products, in the agricultural products industry, it grows wheat itself in two regions, so region 1 and region 2. The entity also buys wheat from a supplier who grows crop in region 1. and the entity mills the wheat and sells it to customers. Now, the entity's business model depends on water because growing wheat relies on rainfall and on irrigation from other water sources. Now, in Region 1, they currently have high baseline water stress, and the entity expects the water stress to become worse over the medium term. And remember, in Region 1, they themselves grow wheat, but also one of their suppliers grow wheat in that area. So the entity identifies water scarcity as a climate-related risk to which it is exposed. So climate-related risks are not just limited to risk associated with greenhouse gases and emissions. Water scarcity is also a climate-related risk. So climate change drives water scarcity in Region 1 through increasing temperatures and changing precipitation patterns. As a result, there's likely to be significant reduction in the water availability in Region 1. So water scarcity can affect the entity's prospects because, for example, reduced water availability can disrupt its own wheat production, and it can increase the price it has to pay to purchase the crop from its supplier. So, supply and demand, if there's less crop available to buy, you'll have to pay more, and you will struggle to grow your own wheat as well. So again, a nice example on climate-related risks in the agricultural space. Another example around a risk was if an entity operates in the electric utilities and power generation industry, and it generates electricity from both renewable and fossil fuel sources and sells that electricity to customers in the jurisdiction. So again, there's an example on how that would impact climate-related risks. So I'll leave that one with you. So we've talked most of the session now about climate-related risks, but you should also assess your climate-related opportunities. And now, due to time constraints, I've got about 7 minutes left. I'll have to fly over these, but useful resources from the TCFD recommendations. So here we're looking at, are there some opportunities for your business around resource efficiencies? So reducing your operating cost because you're more efficient. Maybe there's energy source, opportunities around using renewable energy. Maybe there's opportunities around the development of new low emissions products or services. Maybe there are new markets that's emerging that you could explore, and then also the resilience on how you could respond and how quickly you can respond to these climate-related risks and opportunities. Again, and this is not a mistake, I've had this slide earlier, but I brought it in again. It's really important to consider the financial impact of these opportunities. To just say we've got all these opportunities, what will it mean dollars? What will it mean for the balance sheet? What will it mean for revenues? That's the trick. So again, in the TCFD report, they talk about if you look at resource efficiency, maybe we can use a more efficient mode of transport. Maybe we could use more efficient production and distribution processes. Maybe we could use recycling, circular economy. Maybe we could use more efficient buildings. Maybe we could reduce our water usage and consumption. And again, if we could do all those things, if we could explore those opportunities on the right-hand side, what would the potential financial impacts and benefits be? Again, you can look at those. If you look at energy sources, maybe we use a lower emission sources of energy. Maybe we use new technologies. Maybe we participate in the carbon market. Maybe we shift towards decentralized energy generation. Again, what would it mean financially? And what about products and services? We develop new products and services. We do significant research and development and innovation. Maybe we have the ability to diversify our business activities. And there could be a shift in consumer preferences towards our new products. Markets, there's new access to new markets. Maybe we use some public sector incentives. Maybe we look at new assets and locations, and the related to insurance availability. And again, resilience. Let's look at renewable energy. Maybe we adopt energy efficient measures. Maybe we have resource substitute diversification. And again, what would that mean for the dollars? Around climate-related risks, the example that was included from the ISSB, remember earlier I had two risk examples, example 1 and 3. Example 2 that they had were around an opportunity, actually. And here they talked about the entity operates in the forestry management industry. It grows and harvests trees and sells the timber to companies that manufacture wood-based products for the building sector. Now, the building sector generates significant greenhouse gas emissions, which are the primary driver of climate change. In recent years, a number of new regulations, building codes, and other industry standards have been developed with an aim to reduce such emissions in the sector. As a result, the market demand for timber is growing because using wood instead of other building materials such as steel and concrete can help meet the new regulations, building codes, other industry standards, and achieve decarbonization. Now, that is because trees absorb and store carbon, and manufacturing wood-based products produces lower greenhouse gas emissions compared to other materials. So the entity identifies this growing market demand for timber in the building sector as a climate-related opportunity to which it is exposed. And the entity determines that it can increase its revenues by responding to that demand, which obviously affect the entity's prospects. So that's an opportunity. In the TCFD guidelines, they also have some guidance across different industries. Now, due to time constraints, I'll just flag these. They've got 4 groups, and I've got all the links there. So they have the energy group, and they say energy is a critical element in the economy, serving as a primary or necessary input in most economic activities. And then in this group, they look at all the organizations that are extracting, processing, producing, and distributing fossil fuels or electric energy to other sectors in the economy, right? So here they look at the industry is energy, but they look at sub-industries, oil and gas, coal, and electric utilities. And then we also have, there's a bit of a discussion around options available, but there's also the transportation group as an industry, and sub-industries will be air freight, passenger air, maritime transportation, or rail transportation, if you're providing trucking services, and automobiles. So again, some risks and opportunities. Another one is if you look at materials and the buildings group. So here we've got different subsections: metals and mining, chemicals, construction, capital goods, real estate management and development. Again, what could the risks and opportunities be for you in those industries? There's a group called Agriculture, Food and Forest Products Group. So here we look at sub-industries, beverages, agriculture, packaged foods and meat, etc. Finally, I would like to look at a climate risk assessment methodology. So the methodology that we use is we start by identifying climate-related risks and opportunities, and we consider them, look at the impact and the likelihood, and we look at it over the short term, medium term, and long term. Then we would, after we've done all that work, we would discuss our outcomes with the leadership team and get their feedback. We will then go and assess the control environment. So what are the key risks we've identified? What are the controls already in place? And identify any gaps. And then we would consider, how do we bring these risks, these controls, into your normal risk register? Because sustainability and climate should not have its own risk register. It should be embedded in your normal risk register. And finally, we prepare our report. So that's a methodology, in short, that we use. Um, what we expect to see is that the outcome of a climate risk assessment end up in your risk register, which will have the normal categories, the risk name, the description, and we've got the categories that lines up with the TCFD recommendations. Who's the risk owner? We look at the inherent risk rating before we consider controls. What's the likelihood, the consequence, the rating? Then we look at the current control environment. So what are the existing controls and what's the existing control rating? And then we deal with what are the residual risks and what is our action plan. So if we've got a residual risk, which we don't want to accept, but we actually want to manage, what is our action plan? So that's usually the structure. This just gives you a little bit of an idea how we look at likelihood, how we describe consequences, and then we look at controls, how we describe controls, and finally, how we could potentially describe a residual risk. Um, so, first of all, thank you very much for joining me today. This is a really fascinating area, climate risk assessments. At the moment, we are really busy conducting a lot of climate risk assessments for clients. So if you need help, please reach out. We would love to help you. Um, so, climate risk assessments, part of our sustainability reporting journey, but it could also be part of your sustainability strategy journey. We could help you there as well. These are the key contacts across Australia. Please feel free to reach out. We've got some insights, we've got some learning on our website. But thank you very much for joining me. I hope we can speak again next month when we look at scenario analysis. Thank you very much.